All right, we're going to go ahead and get started with our AES for today. I'm pleased to uh, let you know that we have a great speaker for you today. We're talking about understanding association financials, and we have an excellent person to deal with these. He's an expert in this sort of thing. And just before I introduce him, I want to remind everyone that there is an education scholarship that HOA Living is offering. Anybody that's heading to school that would like to apply for this scholarship, it's up to $2,500. These scholarship applications are due on June 30th. So if you please, we'll let people know that are going to school that's available. There's a couple of hoops they have to jump through to apply, and then we'll select the scholarships based on those applications. So if you could please let anyone know that was going to school, that would be fantastic. We'd love to be able to help someone in their paying for their school. Our presenter today is Scott Anderson. He's our Vice President of Community Management with our CAM organization. Scott is a PCAM, which is the highest designation you can get in this field as a community manager. He also is just a wealth of knowledge. Whenever I don't know what to do with something or I have questions, he's one of my first people that I go to. He's got so much knowledge about this particular field. So I think you're really going to enjoy having Scott take us through these financials today. I'm going to go ahead and turn the time over to him, and I'm going to stop the sharing of my screen. He's going to go ahead and share his screen, and Scott, take it away.
Thanks, Darren. As we get the screens switched over, um, you are too kind. Let's see here. Let's make sure that we can do this. All right. Is it showing appropriately, Darren?
You're showing, there we go. That's the right one.
All right. Perfect. All right. I'm actually really excited. Darren, you're too kind. Thanks for the great introduction into what we're talking about today. So we're talking about association financials. I think Darren likes to choose me for the topics that are not like super exciting. Uh, Last time I talked, I did governing documents. This time, association financials. This is the part that nobody particularly enjoys, but it really is one of the more important aspects, if not the most important aspects of HOA management for the board and also for the management company. A lot of association complaints and frustrations revolve from association financials, either not budgeting appropriately, which we'll talk about at a later AES this year, or whether it's looking at the contracts or looking at different aspects of management, whether it's collecting your fees of the financial aspects. A lot of those frustrations come from a financial base. So if you understand your financials, your financial position, then some of those other things kind of tend to take care of themselves. And we'll look at kind of what I'm talking about a little bit later. So to get us started on association financials, this is our kind of our agenda for today that we hope to touch on and make it meaningful. First, we're going to touch on board duties. What is the board responsible for as far as association financials? Then we'll look at some accounting methods and the different types of accounting methods. Then we'll look at actually the financial reports and understanding the financial reports. And then really what homeowners need to see. Um, because that's right, like that's a big question of like, hey, where does my money go? And so we can see on those financial reports where the money goes. So let's get started on board duties. So the board really has the the responsibility of the financials. But before to like even lay the foundation, they have the duty of care, duty of loyalty, and then your treasurer plays a big role in the financial health of the associations, and then where professional management, which of those responsibilities can be delegated to your professional management company and what they're really responsible for. So let's look at duty to care and duty to loyalty, duty of loyalty. So the board really has the responsibility, duty of care, which is to act in a reasonable and informed manner as a board member. And then also the duty of loyalty to act in good faith and in the best interest of the community. So how does that play in? How do both of those play into the association financials? First, act in a reasonable and informed manner when acting as a board member, right? Like board members really should understand where the money is going. What are your financial obligations as an association? What contracts have you signed? What do your documents require as far as association, as far as association maintenance, as well as assessments? What can and can't you do? Board members need to be informed on that. A lot of times we default to the management company, because they're in it every day, and board members have other interests, or they're retired and had a professional career. But as a board member, you really need to be informed on what those things are. And then a duty to loyalty is to act in good faith in the best interest of the community. This one really comes into play, and again, we'll touch on this again when we're talking about financials and like assessment levels, right? Nobody loves to raise their assessments, but is it in the best interest of the association to raise assessments, in order to provide the level of service that your owners expect or the board wants, or to make sure that those funds are being used appropriately? So that's really the basis for board members before we even get into the financial aspect of what is happening within your association. So the treasurer is the person in your association that's really responsible for the financial health of the association. They're the ones that is the board's chief financial voice and liaison with the financial specialists or the management company. Under their direction, they prepare the budget to make sure that the assessments are being used in accordance to the governing documents, the community needs, and as well as what the community wants. So if there's programming, if you're in a big master development that offers some lifestyle and some lifestyle components where the community is driving those, or even social programming, that engagement for your owners, and as well as like the reserve study, making sure that the board is reviewing and understanding the reserve study needs. Uh, that's really falls to the treasurer. They're the chief person that oversees all of that. They follow up on the budget, they review the financials, and ensure the reserves are being properly funded in accordance to um, the board's decisions, as well as the reserve study needs, as well as, just sort of what they feel is best, and making sure that they're executing what the board wants. And then they work with the board to address the financial status and changes. So as we approach the end of the fiscal year, what those budget comparisons should be, what the assessment level should be. Can we hold them steady? Do we need to raise them? Those sort of things, right? So, where does the management company come in on that? Professional management, the community manager works under the treasurer's authority, or should work in conjunction with the treasurer to put the draft of the budget together. Typically during the draft budget process, or the budget drafting process, excuse me, the manager puts it together, sends it over to the treasurer. The treasurer then works with the manager to make some adjustments, and then it gets presented to the board at kind of a later date. But there's some work that is happening between the management and the treasurer prior to that. They identify issues and decisions before going to board review, right? And so it really, the treasurer should be involved, and we shouldn't be getting to a board meeting where the treasurer hasn't seen that budget prior to it being given to the rest of the board. The professional management also executes on collecting the assessments, making sure people are paying. They're processing payments out to vendors and understands and is reviewing the financials along with the treasurer to make sure that we're meeting those budgetary line items as well as keeping those costs. And so the question always comes up in board meetings, when can we afford this? And so when we're making those budget comparisons or projections out, that's where professional management can help with that. And then they compile the monthly financial reports to maintain transparency and provide that and answer questions to the board or owners if there's any questions that arise. And so the community manager, again, the community manager and the treasurer should be working fairly closely on all of these items to make sure that that is seamless, to make sure that the treasurer is fulfilling their fiduciary duty, as well as acting as a checks and balance to professional management to make sure that those expenses are being allocated correctly and appropriately in accordance to the budget. So they maintain financials, all financials and accounting records. They oversee banking and operating and savings, overseeing assessments and delinquent procedures as we'll look at a couple of those reports, but as outlined by the board, in order to make sure that we are maintaining a proper financial status, preparing and presents the budgets at your annual meeting or during financial review, during your board meeting, files income tax returns and works with the reserve specialist, CPA, insurance agent, and your other vendors as they to make sure that though the contracts are being fulfilled and that again they're in line with what the board wants and desires as far as their service needs. All right. So here are some accounting methods. So the accounting method, we have cash accrual and modified accrual. Cash accounting, we're going to look at in specifics here in just a second, but cash accounting, accrual accounting, cash accounting is probably what we're most familiar with. Accrual accounting is a little bit more abstract, and modified accrual is sometimes called modified cash, modified accrual, depending on who you're talking to, is a combination of both of those things. So let's look at the specifics. So cash accounting is probably what we're most familiar with. It's what we generally run our homes on. We record income that's received and we record expenses when they are paid out, right? So money in, money out. This is how we do it. We get our paycheck, we record the $100 paycheck, we go to Burger King for lunch, it's $10. And then we make sure that, right, that we now have $90, right? And so like we're tracking the money in, money out. That's the easiest. It's probably the most straightforward for what people need to do because they're like, hey, we have $90 after our lunch to spend on something else. Let's figure out what we want to do with it. Accrual accounting is a little bit more abstract, and we record the income as we've received it as we've billed, and meaning on the first of the month the association on their financials view the income as been 100% received. Whether people actually pay or not is secondary to the accrual. Like, it's for the accounting purposes, we are counting that money as having been collected. So if your association budgets to collect $3,000 per month in assessments on the financial statements, it will show that the association collected $3,000 a month. And we'll see how this all kind of plays out in the financial reports in a minute. And then the expenses are categorized in the month that the service was performed. When the bill is actually paid is secondary to this. So for example, if you call out a plumber to do some work in May, but you don't actually get the invoice until June, and then you cut the check in July, on the financials, because the service was performed in May, that invoice would be backdated back to the May financials. And so again, this one's sort of abstract in keeping track of where the income and the expenses go. But the thing you need to know is the income is recorded, it's collected as soon as it's billed. We treat it as being 100% collected, and the expenses are put into the months where they actually occur, not where the invoice is paid. So in the HOA world, we run a modified accrual or modified cash accounting system where it's the combination of the two. The income is recorded when it's assessed on the first of each month or whatever interval your association is. If it's annually, whatever month that is. If you collect 100% of your assessments in January, then that's where it'll show, and then it'll show 0 for the rest of the year or monthly, right? And then the expenses are recorded when they're actually paid. So in the example that we used earlier, with that plumbing invoice, if you call out a plumber in May, you get the invoice in June, and then you actually cut the check in July, that payment or that expense will show up on the July financials. And so there's some reasoning behind that in order to get some of the financial reports to work correctly, which we'll look at in just a second. But that's where the HOA world and industry standard is on this modified accrual, modified cash accounting method. It's accrual on the income and cash on expenses. So let's look at the financial reports, and we'll spend some time on the financial reports. So the standard financial packet that we provide, that management provides to clients, is the balance sheet, the accounts receivable or the aging delinquencies. It has different vernacular, but it's accounts receivable, the statement of revenue and expenses, or the income statement, P&L, in different profit and loss statement in different formats. The GL trial balance, which is the general ledger trial balance, and then the bank account reconciliation, which is a pretty standard report coming from the bank statement. So, as a reminder, in Vantica, board members have access to a whole bunch of reports, probably more than you really need or ever thought that you might want. But you can pull a whole bunch of financials and you can get the numbers kind of how it makes sense to you if the standard reports don't. If you want to see them in a slightly different way, there's a whole bunch of reports that board members can pull. It's live data. As we collect money and expense out, you can adjust the parameters on those reports. And so it really makes it really nice for the treasurers on your board, or even board members that are curious to go in and pull different reports and look at them in slightly different ways. So let's look at the balance sheet. So the balance sheet, pretty straightforward. This is the one that everybody's like, woohoo! This is where all of our money is, and this is the financial health of of our association. So what are we looking at on this one? So the balance sheet is all, this is just the top part of the balance sheet. We'll look at the bottom part in just a second. But this is a list of your assets broken up by either your operating accounts or your reserve accounts, and then it just gives a subtotal of your association. So we can see on this one, they have roughly $21,000 sitting in operating accounts between some operating savings at different financial institutions. And they have about $31,000 in reserve accounts, and then a significant accounts receivable, which is traded as assets to the association because it's money owed to the association. So you can see this one's pretty straightforward, giving you your operating accounts, your reserve accounts, and then just a total of total assets if you were to collect everything. So this association would have roughly $62,000 in total assets that they could expense and make sure that they're meeting their financial obligations. The bottom part of the balance sheet is a little trickier and trips people up. So what we look at is this top liability, these top two lines on under the liability, the deferred revenue for this particular association reserves short-term and deferred revenue reserves long-term. Back when I first started my career, this line didn't exist on the balance sheet. We only saw the reserve accounts and we saw them as assets. What would invariably happen is when there was a cash flow shortage for the association, boards would ask, hey, can we take money from reserves and pay operating accounts? Different, depending on where you're at in the country, there's different laws that stipulate what you can use those funds for. But in general, right, we're like, no, because yes, it's listed as an asset, but no, you can't use it for whatever you want. So GAAP rules kind of changed, and it's a different way of looking at your reserve monies. Really, what your reserve money is for is you're saving for reserve expenses that happen in the future. So you're prepaying a liability for service that needs to happen, whether that's your asphalt roads, whether that's roof replacement, whether that's pool maintenance, whatever that happens to be. And so these two lines, the deferred revenue reserves short-term and the deferred revenue reserves long-term, capture that idea that this is a prepaid liability, that we are saving money for work that needs to be done at a future point. And so we owe our owners this work to be done. And so you can see that this for the deferred revenue for reserves balances out pretty closely to the actual amounts that are in the reserve accounts. They may be off by a few dollars for interest purposes, as they're not classified in the liability line item, but they're captured in the accounts. But they're pretty close based on the interest. So what's the difference between the short-term deferred revenue and the long-term deferred revenue? So the short-term deferred revenue is the reserve contributions for the current fiscal period. So the year-to-date fiscal reserve contributions are captured in the short term. Once you get into a new fiscal period, or like December to January, that will zero out. The short term will zero out or capture what the new one is in the first month, and then all that money will roll over into long term. When we're making reserve expenses, that money, the reserve expense, when we transfer the money out to pay for the roof repair or the pool expense, comes out of that deferred revenue reserve long-term line item. And so they adjust, and again, that's all to say that matches what the balances that are in your reserve accounts, to make sure that you're properly funded for your reserves. And so it's a little bit of a change, but if we think about, again, reserves or the reserve requirements as being a prepaid liability, then it makes a little bit more sense. Again, so the bottom part continues with the prepaid assessments. Prepaid assessments is services treated as a liability because owners have prepaid for services that they've yet to receive. Again, whether that's like access to your pool area, whatever it happens to be, that's why it's treated as a liability. Suspense trips some people up. The suspense line item on this balance sheet, or suspense in general, is just a holding category for items that don't necessarily have a home. So sometimes we get payments, the association receives a payment, and the name doesn't make sense, it doesn't match an owner. The address on the check isn't to an address within the association. It's like a second home type situation, and we don't know where to apply that payment. But it's made out to the association. So where do we put it? We put it in suspense until we can figure out which owner to apply that to, or whether we have to return it, or whether whatever it happens to be. Or if you have an expense that's set up on an auto pay situation and they auto deduct it, when it comes back, if it hasn't been reconciled yet, it will sit in suspense. The goal is to clear those out as quickly as possible. So 90% of the time, you won't ever see a suspense line item on your balance sheet. If you do, it's one of those rare situations where there's some income that was received or an expense that popped up on the bank statement that we don't know exactly where that goes, and it requires a little bit of research. But again, those are generally cleared out within about 30 days. And so suspense really isn't something to be super concerned about. If you have reoccurring items that are showing up in suspense month over month over month, then it warrants a question of like, hey, where does this go? We found it. If it's the same amount, then it warrants the question and some further investigation to make sure that those items get taken care of appropriately. And so these, like, that's your liabilities. And then the bottom part, the capital, the retained earnings and the net income also trip some people up, managers as well as board members, of what that is. So retained earnings is the history of the net profit or net loss of the association just over time since our management. And it resets at the end of, well, let me back up just a hair. So the net income is your year-to-date operating loss or operating profit, and you can track that on your income statement. We'll show you exactly where in just a second. That will move up or down as we move through the year. At the end of the fiscal year, typically in December, but sometimes if you're not quite on the calendar year, when you rotate into a new fiscal year, that net income will reset to be year to date. And whatever the number is, whether you have a net profit or net loss, will roll into your retained earnings. And so your retained earnings number changes one time a year when you change over fiscal periods. That, again, that will go up or down dependent on if you ended the year at a net profit or a net loss. And so people tend to ask what those are. That's how that works. And so, like, let's look at the accounts receivable now. So accounts receivable is a list of all the outstanding charges, details of each delinquent owner, and the current collection status. And so this report often gets a lot of attention. And so the top of the report is really nice. It gives you a quick summary of the breakdown of the types of charges that owners are delinquent with. So in this case, on this one, right, we can see $1,100, just over $1,100 delinquent, but most of that is made up of monthly assessments with very little interest and very little collection action happening. And so you can see most of it is principal owed to the association. When we look at the individual account information, we see the same sort of thing in an aging format. So on this particular owner, they owe roughly $550 each month, with a little bit of interest and some collection actions on top of it. And so your aging report is a nice breakdown of providing what are the hard costs for the association. So your assessments, your collection fees, any legal collection action, and then some soft costs that may offer you some negotiation, which is the late fees and the interest, as you're working through those delinquencies, to make sure that you're properly funding your HOA. So here's a revenue of expenses, or your profit and loss. Your income statement, again, has sort of different names depending on the situation that you're in. But the report is titled Statement of Revenue of Expenses. So it's the financial transactions during a specific period of time, and they compare what was expensed during the month or what was charged during the month versus what you were budgeting, and then provides any sort of variance. So the first set of columns is the current month of the report. So in this case, this one's February 2023. This is the statement of income as we're looking to the top part. And then the second column is the year-to-date information. So January and February, and then a variance compared to the total annual expense. So again, this, like, to rewind a little bit on the modified accrual. So here we're looking at this association has budgeted to receive $116,000 in income each month. You can see, hey, we've collected $116,000, so there's no variance here. Some of these other ones are the one-off charges that happen through the course of management, whether it's late fees, interest, key fees, and these different fees. And so you can see the different income, and we don't budget for these secondary fees. You shouldn't be operating your association on the secondary fees. You should be operating your association on the monthly assessment. This particular association, I'm guessing, is fairly new, and so they've budgeted to receive reinvestment fees, which is unusual. But as they are planning forward, there's some extra income for there. So what are we looking for on the income statement? And really, when we're reviewing the income statement, what are the things that we're looking for? So first of all, we're looking for any sort of variances, large variances. So on a quick glance, we can see on this association, they had budgeted to expense $325 in copies and postage. They actually spent $560, give or take. And here's the variance of roughly $230. So whenever there's a variance, you're either under budget, over budget. And so the reason why is that? Did you have your annual meeting mailing that month that you're going to be high, and then you're going to kind of taper off the rest of the year and even that out? Or was there an unexpected expense? For example, here, hey, they budgeted for professional services, taxes. They budgeted for $2,500, but they actually expensed out $16,000. That they have a $13,000 variance. Why is that? Could be various reasons. In this category, could be for tax purposes. You have a large tax bill, or if you have some legal fees or whatever, right? Looks like they have a couple here in this particular association, but you want to know why that is. And in that month, it will show you why you're way over budget. So you can make adjustments later down the year if you're like, oh my gosh, particularly in landscaping, if you're way over budget on your landscaping, we may need to make some adjustments for the rest of the year to make sure that we don't continually go way over budget, or we're aware of it and we're doing this by board decision. We know that that's what's going to happen, but you want to look at variances first to understand where the money's going if things have been categorized correctly. That's the second one. The second one is making sure that things are categorized correctly. So, do you have any expenses that line items that you've expensed money in that you don't have a budget for? For example, here, landscaping, this line item, there's $153 expense, but there's no budget associated with it. Does that mean that was an unexpected expense? Excuse me. Unexpected expense that wasn't planned for, or is it just in the wrong GL? And so as we're looking at those financial reports and we see those line items where there's not a budget for it, we can make those adjustments and make the proper adjustments so that your financials look clean and are appropriate for owners when they're looking at excuse me. So the net income for your association, we tend to go down to the most excuse me. We tend to focus on the bottom line. Are we up or are we down? Which is really good. So this association, they are running under budget, but you can see they haven't received a bunch of bills, or it was a slow snow year, whatever it happens to be. But looking at some of the specifics and understanding the variances and making sure that GL items are appropriate is what the board and the management company should be looking at. The GL trial balance is a list of all the expenses for each general ledger line item. Easy way to confirm that expenses are being coded. I like to say that this report is the numbers behind the numbers. So for example, when we look at this legal fee, we see that there's $16,000. Is that one $16,000 invoice or is it aggregate of multiple invoices? And you can see that through the general ledger, the GL trial balance that shows the expenses. And you can see that that $16,000 is made up of multiple invoices, some general representation, as well as a retainer fee for a particular, like I would imagine, a particular difficult legal situation. And so when you're like, oh my gosh, why are we way over budget? You can see, hey, what is that actually made up of? Is this our standard contract, particularly with landscaping, and then a couple of repairs, or whatever that happens to be. But it gives a better understanding of what the numbers behind the numbers are that you're looking at on the income statement. And so let's see here. And then the bank reconciliation report is the final one that shows all reconciled and unreconciled items. It gives you the book balance for those of us that are old enough for checkbooks. They understand the book balance of the association, and it represents those checks that have been written that haven't quite cleared everywhere. And so the money that you can actually work with. So, those are the financial reports. Again, like when we get into board meetings, the financials kind of take a back seat to some of the other stuff we want to talk about, whether it's the clubhouse and how often we should open it, or the public swimming, or should we be doing lap swimming. We tend to focus on those items, and the financials kind of take a back seat to all of that. But really, the financials play a foundation to how those decisions can be moved forward. So if we want to open the clubhouse to a greater usage, then we need to look at the financials and see if our current assessment levels can support that decision or not. So as owners, what do owners entitled to? So each month through the portal, owners can see the balance sheet and the income statement that we just looked at, the board can that the board gets. The budget. The budget should be posted on the portal or in a public setting for owners to be able to see. Oftentimes, your documents have a notice requirement to provide the budget prior to the fiscal year, to the start of the fiscal year, or in conjunction with the annual meeting. That's typically when we send it out, is with the annual meeting, so people know what assessment levels are going to be. But your documents may require you send it out additionally 30 or 60 days prior to the start of the fiscal year, so people can see that and then have it posted so they can refer to it later. The meeting minutes for all board meetings, as well as any budgetary discussions as you're preparing the budget, those meeting minutes and the reserve study. It has to be posted on the portal and accessible for owners. And the reserve study really should be leveraged in budget preparation and referenced on a regular basis in order to make sure that you are properly funding and properly maintaining the assets within the association. And so these are all the things that the owners are entitled to. These are all the things that the board should be looking at and reviewing on a regular basis to make sure that your financial health is there. So those are the financials. That's what we got. Again, sort of, hey, the financial piece here is really the underpinning to all the other things within your association. And as you understand your financials and review your reports on a consistent basis, I shouldn't say fairly, on a consistent basis, some of the other problems, landscaping and some of those other things, tend to take care of themselves again, because you have the money appropriately for the services that you're trying to accomplish. That's
All
what we
right,
got.
Scott, thanks so much for all that information. We do have a question that someone posed.
Yeah.
For Clara, who, the management or the board, are responsible for investing monies?
Investing monies. So we can talk about that. So the fiduciary duty lies with the board in order to invest money. When you invest money, there's three principles when you invest money. The first one is liquidity, safety, and the yield of your money. Those are the three principles that we shouldn't be investing on. Most of us focus on the yield, how much money we're going to get. And so, but when we invest money, that's the least important aspect to investing. We need to look at first safety. What are the risk factors involved in investing? And so there's not a single one of us that want to stand up in front of our membership and be like, yeah, we started the year with $100,000 and now we have $50,000. We don't want to lose the money. So safety is the number one thing. Liquidity, how quickly can we access the money in case of emergency? So tying all of your money up in like a 5-year CD may not be the best plan. Ladder those, or if you have them in a money market, are they most liquid, right? And then the last one is yield. As long as you have a safe investment and it's fairly liquid, then yield comes into play. There are financial institutions. But where does that lie? Where does the responsibility, getting back to your actual question, where does that responsibility lie? First, it lies with the board, as it's their fiduciary duty. The management company can offer suggestions and put you in contact with some different people, but the board needs to make the decision on what their risk tolerance is, what their investing strategy is, and where those investments lie.
All right. Another question, are financial statements audited and who is ultimately liable for the reports?
They can be audited. Some documents, some association documents require an annual audit. In those cases, a outside CPA firm does the audit, and the management company or the manager will work with the auditor to make sure that they have the appropriate information. The what was the second part of that question?
Who is ultimately liable for the reports?
Who's ultimately liable? Like the board, there's a checks and balances there, right? The management company provides them to the board. The board has the chance to review them and accept the financial reports as stated, or if request changes, and then the management company inputs those requested changes. But the management company works under the direction of the board. Ultimately, the board is responsible for those financial statements to make sure that they are appropriate.
Great. Okay, thanks for that. Looks like, what fiduciary responsibility does the HOA management have when the board isn't holding money in reserve?
Isn't holding money in reserve, like they're not contributing to their reserve account, I'm guessing is what the question is.
I think that must be it.
So the management company, again, works under the direction of the board. We can advise and we can request, and we can put it on the budget of a reserve contribution. We can reference the reserve study on what those reserve contributions should be according to the reserve study. But again, ultimately, the board is making those decisions. We management companies have been, and managers have been known, hey, to make a point in the minutes. I want it noted in the minutes that this is the level of reserve contribution that we are recommending in order to go on public record. Having those minutes available to owners creates an accountability that owners can hold their board accountable for properly funding their reserves. What we've seen over the last couple of years, particularly with disclosures and out-of-state owners moving to Utah, is they're more adept to reserves and reserve funding. And so if you are not properly funding your reserve, you're creating a less desirable community within your association. And so it's a long way of saying that lies with the board, and the management company can only make the recommendations, and ultimately the board is making those decisions.
Okay, next question. Where are the bank accounts holding operating income and reserves? I'm not sure what this person means. I'm assuming they mean where are the best places to hold operating income and reserves?
So again, like right when we're talking, the light in my office made me go. When we talk about investing in those principles, right? Like we're looking at safety, we're looking at liquidity, and we're looking at yield. HOA Living has a preferred banking partner, and so those operating accounts is because it integrates with our system. They're holding it there. The boards can choose to hold their reserve funds elsewhere. Where they're holding them, it could be money markets, could be CDs, could be CDARs, depending on the amount of money, and some different investing strategies there. I don't know if we hit on that question. Let's see here. Maybe that answered it. Maybe it didn't.
Yeah, that's maybe the person who wrote that question could could supply us with a little more information.
Or if you want to send a follow-up email to Darren, we can do our best to
Absolutely.
get a more robust response kind of after this.
Yeah, if you have any questions after this, you can send them to training@hoaliving.com. That will get them to me. So next question, is there one place to quickly look at financial reports to see the amount of assessments actually collected that month, as opposed to the modified accrual cash accounting number, assuming all assessments were collected?
There is not. It requires a little bit of math. Looking at your aging delinquency, if on your delinquency report, if you look under the 0 to 30 days, anything that's unpaid, and then subtract that out from the total amount budgeted. So if you have, right, if you have $300 in outstanding assessments in that first column, 0 to 30 days, and you've budgeted to receive 5,000, then you receive $4,700 of assessments. That's really the only way to see it. There's a couple other reports, like your deposit report, but that will track some other things that come into, if you get like a refund from a vendor, that sort of thing, it'll all show up on that report either as well.
Okay, we've still got a few more questions. This is great. Let's see. Um, what should meeting minutes consist of, and how detailed should the minutes be? That's a little off topic, but it still has something to do with what.
That's okay, right? So, your minutes should be, hey, we review the financial reports and we accept them, accept the reports as stated. If there's questions about, that's really as detailed as they should be. The specifics, if you're going over aging delinquency, you don't want anything in your minutes that's gonna be potentially slanderous or be identifiable for somebody not on the board that could indicate, particularly when you're talking about aging delinquencies, like who your neighbors are not paying. But right, like if you have a large variance and you want to make special note of like, hey, we had a large pump repair expense, you can put that in as well. But really it's limited to, hey, these were reviewed and these were accepted. There weren't any questions. Or if there were questions, hey, put those questions in and away you go.
Okay, should a hired management company provide a GL trial balance listing invoices and checks? If they do not provide a GL trial balance, what can you do about it?
Like a check register. So our the GL trial balance that we provide shows you can ask for the details. They should provide that to you, to the details, especially if there's questions of like large dollar amounts, and they should be able to provide that for you. And so, yeah.
Okay. And then what, if any, duty does a management company have to an HOA committee? If a company misguides a committee, is there liability for misinformation to board members?
Like a financial committee, I'm guessing.
It doesn't say what type of committee.
I would need some clarification on that one. I'm not sure what they're getting at on that one. We can
Okay,
get
so
some
Catherine, if you can email us at training@hoaliving.com, we'll get some more information on that and get back with you on that. Let's see. Are retained earnings taxable, and are reserves taxable?
So retained earnings, there is no money in that retained earnings. It's just a number that shows, hey, we were up in 2024, we were up $500. In 2025, we were up $700. It's just an ongoing ticker. So there's not money. So saying that taxable is the answer to that is no. Are reserves taxable? The interest on reserves is taxable. The money contributed to the reserve account is not taxable. HOAs only pay taxes on non-assessment income. So if you're paying for like if you have a laundry facilities or a vending machine or whatever, and there's some profit share situation going on, you will pay money on those things as well as any interest gained through your bank account.
Okay, here's one, I think from a homeowner. What do homeowners do when the board will not properly fund the reserve? What options do they have?
You can go to board meetings, demand it. When they say will not properly fund the reserve, there's some indication there that they're keeping, there's an implication there, I should say, that they're keeping fees artificially low, so there's not money. And so if you're properly funding, then those assessments may need to increase. Get on the board is another option to get involved. But really go to the board and hold them accountable and ask the tough questions and say, hey, what is our reserve study says this? Why are we only putting in this? And there may be a reason for that, and but ask the tough questions at a board meeting.
Okay, this last question we've got here, back to the landscaping incurred expense that was not in the budget that you showed.
Uh-huh.
Assuming it's a non-budgeted event, how do we prevent this type of expenses before there's a commitment to spend?
There should be some conversation with your vendor, right? Like, depending on what the contract is, sometimes contracts like the vendor will go out and perform a repair, like a sprinkler line repair or replace a sprinkler head or whatever that happens to be. If it's outside of the standard contract, having a conversation with your vendor of like, hey, this is limiting what they're allowed to do before they go on, having a conversation with your management company of like, hey, anything outside of routine sprinkler repair, pipe, whatever it happens to be, um, understanding what those parameters are and then executing those parameters. Um, and then, yeah, that we'll leave it at that one.
Okay. There are a couple other questions, but I'm gonna handle those by typing answers in. If Catherine and Clara, if you can stay online, we're gonna go ahead and I'm gonna get some answers for you there. Um, we appreciate all of your time. Um, I'm gonna go ahead and can you stop sharing your screen there, Scott, so
Yeah.
I can share mine. All right. So our social media, we've got a QR code for that. Our community scoop, which is our monthly community e-newsletter. All of those things that are available for you. On YouTube, we have our AES sessions that are recorded and posted on our YouTube channel. And there are recordings of our previous AESs. Well, this one will be on there available soon. If you enjoyed it and want to share it with somebody, then that's a good place to do it, is on YouTube. Access previous topics of our AES series. You can do that at hoaliving.com/AES for Association and Education Series. You can look at those and view those recordings as you need to. Our last announcement is next month. We have RFP and contract business partners. That'll be on May 21st at the same time, 12 o'clock Mountain Standard Time. So if you can join us for that, we'd love to have you. And if you have RFPs or contract business partners that you want to know, learn more about, and that topic interests you, then great. We'd love to have you come and share that time with us next month. Thank you all for joining. We really appreciate it. And I'm going to get back with these couple of questions. So those of you that didn't get your questions answered, stay online for a moment, and I'm going to give you some instruction on how to get those questions answered. So thanks very much, everyone. Have a great day, and we will talk to you soon.